Good evening, everyone. This is Rajendran here, joining from Bangalore, and welcome everyone to online webinar on how not to trade. Right. So, before getting into the session, a bit about me. I'm an full-time discretionary trader. I started trading the market since 2006 onwards, so it's been more than a decade, and I use predominantly trading analysis concepts like market profile, order flow, and sentiment analysis stuff mostly. I used to build algorithmic trading models, and I'm an systematic trader. Sometime back, probably from 2009 to 2015, I'm mostly into. I build mathematical models. I trade mathematical models, and also I build a lot of market analytics tools. Right. So and moreover, I'm a founder of Market Calls and co-founder of Traders Cafe. So Traders Cafe is an local trading community in Bangalore. And yes, today our topic is how not to trade. Right? This is a topic um, probably one of the topic which is largely missing while discussing. Most of the people talk about how to make money, and probably this session is quite different. So we are talking about how not to trade. Right. So what are the aspects we have to consider? What are the scenarios we have to tend to avoid when we should not get into the markets emotionally? So those are the topics we are going to discuss, and this webinar mostly suits for traders who are very new to the markets, or probably who want to figure out where they are going wrong in the markets. Right. So let's start with the session. Before getting into the session, just give me a quick confirmation whether the audio and video quality is fine. Just one more check so that we can go with the session. And as usual, the session is getting recorded. Yes, the recorded session will be posted on the YouTube probably by end of the day. Right. So let's start with let's make this session quite interactive. Maybe I'll ask a question over here. So what indicators you use in your trading studies? Let's take some. I want your engagement. Just type in your chat section what indicators you use and how long you're using it. Just type it in few words. That is fine. So that we'll start with that. Don't feel shy. And I'm not going to take your. No harm in doing that. Just say what indicators you use in your trading studies. Okay, RSI. Okay, MACD. Okay, EMA and RSI. So this, RSI and the super trend, moving average, EMA, stochastics. Yes, moving average again. Mostly RSI and EMA. So mostly 3 SMA, momentum. Okay, momentum, volume, B bands, Bollinger Bands. Okay, Bollinger Bands. Okay, and Fibonacci. I guess probably there are some more participants. I'll explain what they use. Predominantly, they use Renko, or some people use Ichimoku, or some other people will be using something like range bars, and some people use Elliott wave, and some people use point and figure, right? And mostly some people use market profile, and some uses order flow. So these are very less in numbers, but predominantly most of the people uses the RSI, MACD, EMA, RSI. Again and again, if you check most of the traders, right? So I guess if every trader who was starting with technical analysis, so probably they will be getting very much equipped with RSI, EMA, because RSI, EMA, stochastics, because they find it fascinating for the very first time. For the very first time, people are seeing the time series data, and they find it very fascinating. In fact, I'm also started with RSI, EMA, stochastics, all those technical analysis, And in fact, I find fascinating stuff because I was just thinking how good they are good in uh, predicting the markets. Yes, they are most of the times it works beautifully, but it comes with certain caveats. Those are the certain caveats which we are going to discuss in today's strategy. Right? I'm not saying that these strategies will not work, but there are strategies which involves certain difficulties when we are trading in live markets. So, what are those difficulties? What are the difficulties? What are the difficulties? Let me put this question this way: difficulties we face during those classical technical analysis, right? So one of the major problem is whipsaws. I guess every trader whipsaws, right? So whipsaws is a major problem. It's a major problem with the studies. And in fact, all these things, right? All the above studies, they just merely some mathematical formulas, and volume is nothing but how many traded quantity, right? So quantity. Other things are nothing but mostly derivative of price. All these, your stochastics, all the stochastic Bollinger Bands, Fibonacci, they are nothing but what? They are nothing but derivative of price. Derivative of price. So all these RSI, MACD, EMA, super trend, moving average, EMA, stochastics, momentum, Bollinger Band, Fibonacci, they are nothing but or even trend lines, right? So all these indicators, right? Some people use this. Maybe I'll put in a different class, right? So mostly geometric lines. Some people use geometric lines. So some use Fibonacci. Some people use trend lines. Some people use patterns. It could be harmonic, right? Harmonic patterns. Or some people use Gartley kind of stuff. And some people use triangle pennants, and what else? Flags, right? So, and some people even use trade gaps. Some people use even trade gaps. Some people even trade news. There are a lot of news-based traders out there who trade the news factors. Especially, they'll be very much quite active when there is an events like an earnings result season is there, or they'll be very much active when there is an economic events or political events is there. Yeah, like PNB fraud. So people want to come and short Punjab National Bank, or some people want to come and bet on events mostly. So most likely speculators, right? So I would say that they are nothing but merely a speculator. So first of all, who we are. It doesn't matter whether you're playing a strategy or whether you are playing the news or you are anticipating something in the markets. We are mostly short-term, or I guess mostly intraday speculators, right? So maybe we can say that no, I'm playing a strategy, so I know when to buy, when to sell. I mostly play a strategy. I'm not a speculator, right? So by playing a strategy, what we are trying to do is that we are trying to anticipate something from our indicator, right? So we are trying to anticipate that, okay, this is going to be a buy signal. I'm going to make some money, so I'm going to bet my money on particular trade, and I'm going to make some money out of it. So what does that mean is ideally we are speculating something in the markets. We are expecting something in the markets. So most of the people who are going to use RSI, MACD, or any kind of tools, we are using these kind of tools to understand to understand where the market is going next, and whether it will gonna make money for me or not. So we are mostly short-term or intraday speculators, or in other words, we can say like we are nothing but trading money, right? So trading money, and yes, so there is a so trading trend lines often work in commodity 1 hour chart and above, right? So we feel such kind of things. Trend lines work. So some people will say like RSI works beautifully for me. beautifully for me in intraday trading. Like, so these are our observations. These are our past observation. Probably we would have done some 10 or 20 observation on a particular chart. Most of things are visual confirmation. So most of such observations are nothing but visual confirmations. So visual confirmations. So what some people will say, yes, RSI divergence works good for me. So these are the comments from most of the traders. Right? If you go to the most of the trading community forum, probably 75% of the trading community forum, right? You'll be keep on repeatedly saying this. Oh, GAN works for me very beautifully, right? And then some people will say Aliyar Wave is one of the best finest tool in the world. RSI divergence, you can pick bottoms just like that. So these are nothing but the visual confirmation from the people, and probably they would have seen the successfulness in the past, probably in the past charts, probably in the 4 or 5 times or 10 times or 20 times in a row, and then that gets into a mind thinking that, okay, this could be one of the successful patterns, or this could be one of the successful studies. I have to pursue this, right? So those visual things attracts most of the traders, right? And especially the colorful indicator, especially colorful indicator. So ideally, a trader looks into the charts to do what? So they look into the traders, they look into the trades. So I'm sorry, they look into, most of the traders, they look into where to enter, where to exit, what is my stop loss, what is my trailing stop loss, what is my support, and what is my resistance. Apart from this, does any of the traders cares about anything else? Does most of the traders cares about it? Where to enter, where to exit? There are many things apart from that. Do you care anything? I mean, I'm just asking the question to you people. Do you care anything apart from this? Like where to enter, where to exit, stop loss, what is my stop loss, what is my support, what is my resistance? Apart from this, there is one major thing which is missing. Yes, couple of things which are missing. Yes. Okay, so some of the things which are missing in this list are, probably I'll list it down. As one guy said, one of the participants said, I'll just clear it for our time. So what is missing? So what is missing is, what is the risk-reward ratio, right? So that is clearly missing. So when I'm going to enter into this trade, how much money I'm going to make and how much I'm willing to lose. That's what the risk-reward ratio is, right? And what is the second thing which is missing? Well, what could be the second thing which is missing? Probably I'll say it. How long to wait? You're seeing an opportunity. You're seeing a wonderful opportunity. Can I take it right away, or how long should I have to wait? So none of the indicators talks about it, right? So none of the indicators or none of the technical analysis books talks about how long you have to wait to take your trading opportunity, right? So, and then, so how long should I have to wait to take the trading opportunity? So you're finding a trading opportunity. And how long you'll be willing to wait? Let's say it's an intraday opportunity. It is an let me ask you a question like this. Okay. Let's say it is an intraday opportunity. And how long you will be willing to wait? And maybe let me put you this question to the audience. You can ask it. So how long you'll be willing to wait? Or will you be waiting for an 1 hour, 2 hours, 3 hours, 4 hours? How long you'll be willing to wait? Okay, till we get the entry price. Okay, till target. So when the target comes, everything is over. It's how long you're willing to wait to take the trade. I'm asking how long will you will be willing to wait to take a trade. Won't take time frame like intraday. Okay, so you don't trade intraday. That's good. But the key thing is that many people don't have the patience to wait. right? So that is the main key thing, and that is the most challenging thing as well for a trader. It could be an intraday trader or you could be a positional trader. You are looking into an trading opportunity, and then somehow you want to get into that. Somehow you want to get into that immediately, and then you're not, because most of the people, most of the people, or most of the traders are hungry enough to get into a trader, to get into a trade, probably uh, to 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 uh, to make money faster. Probably that is what most of the beginners do. But what the one step beginner, let's say quite an experienced guy, but still they will be getting into the trade even more faster. They will be doing some analysis, and then they'll not wait even for an hour or two, even if they are an intraday trader, right? But then what they will be trying to do is that they will be jumping onto the train just like that, right? Because they done an analysis, and then they just like that they want to show to the market something, or probably they want to rush up like a mad bull. The moment they'll be waiting for the many traders waiting for the market to the many traders, they'll be mostly waiting for the markets to open. The moment market opens, they will somehow figure it out what to trade, right? So many traders rush in mostly at the market open. Why they rush in? Because of greed. Somehow they'll figure it out. Some technical analysis strategy, high-low breakout, right? Or swing breakouts. It happens, and they want to catch it on the very first hand, and so they cannot wait themselves to. They cannot hold it with their patience. So some people wait. Some people will exit at the very first open because of fear, right? So probably if you see today's US markets, if you're looking into today's US markets, maybe I'll show you what the US markets are doing. So what happened here in today's market is that the Dow Jones fell almost 300 points at the open, right? It fallen almost 300 points today, almost 300 points down negative today. And then what is happening is that many traders cannot handle their emotions. Many people will think like, oh my God, this market is going to crash, right? Many people have that in their mindset that, okay, today the market is going to crash, tomorrow it's going to crash, or day after tomorrow it's going to crash. That kind of mindset, if you are going to have, probably again, it plays a major role in your emotional thinking. That plays an that makes you to take an impulsive decision, and most of the impulsive decision gets into some unwanted trades. Like think about the people who shorted at the open, right? So market often doesn't cares about them, right? So at least the investors, for them it's okay because they don't have M2M, whereas the traders like us, the short-term traders or an intraday traders, every day they have to carry their M2M, either profits or losses, right? So timing the markets, it's quite crucial here, especially if you're a directional trader, especially if you're going to play with a naked call option or a naked put option. Timing is most critical for an intraday trader or a short-term trader. And moreover, whenever a trader plays, most of the new traders, they'll be mostly playing with their they want to play high leverage, because they would have tasted the profits, but now they want more profits. So they'll be mostly looking for brokers who provides high leverage, so that they can bet more with a small amount of money, right? So high leverage kills the trader. Essentially, high leverage kills the trader, right? So what are the other things which is missing from this list? What are the other things which is missing from the list? Where to enter, where to exit, what is my stop loss, what is my support resistance. So we talked about two things, which is what is the risk reward ratio. I guess this is what mostly done by the next level of trader. They are not beginners. Probably they learned that risk reward ratio is quite crucial when it comes to trading, right? So means if I say 20 point stop loss, 20 points stop loss, and 100 points profit. If you're having such kind of strategies, then your risk reward ratio will go to 1:5, right? And often risk reward ratio is a distribution. It is not a single point number like 1:5. Every trade, your risk reward ratio varies, depends upon what kind of trading opportunity you're seeing in these markets. Okay, and then this is the classical problem faced by most of the traders, right? So I guess most of the traders, somehow they will figure it out. Okay, this is my support, this is my resistance. The moment they enter, they will figure it out based upon some techniques, whether using RSI or trend lines or divergence. Somehow they will arrive to conclusion, or Ichimoku. Somehow they will arrive to a conclusion. Okay, this is my support and this is my resistance, right? And most of the traders' expectation is they want their resistance. When the price is reaching the resistance point, they generally initiate a trade thinking that that is going to be the resistance, and it's going to touch exactly, and it's going to reverse, or probably it can go a little bit higher and then it's going to reverse. That is what most of the traders' expectation, right? So again, that is a classical problem, and probably they would have taken a stop loss somewhere below the support zone, right? They would have been taking a stop loss somewhere below the support zone. Maybe I'll say like my stop loss is over here. Probably I'll take some 10 points below the support. That is what, again, and most of the trader plays such kind of games because they believe that this is my support, and they expect the price to touch exactly to there, and then they want to take a trade over there with some 10-point stop loss, and they'll expect the market to bounce back. Like, again, a classical speculator game. Most of the speculators does this. Whether you are no matter what kind of trading studies you use, you would also expect your strategy to be pin perfect. But in your real time, what happens mostly is that, maybe I'll take a classical example of Nifty future charts, right? So maybe I'll bring up Nifty future charts over here. Okay, so this is classical. Let me pull up Nifty futures. This is Nifty daily charts, right? Okay, maybe I'll clear most of the studies. So now Nifty is nearing a major support zone, right? So because it's a trend line support, many people watches this game. We are not the only one have access to the tools, right? So probably thousands and thousands of traders have access to the same information, and everyone watches the same movie right from morning 9:30 to 9:15 to 3:30. You watch Divergence, I also watch Divergence. You watch Head and Shoulder, I also watch Head and Shoulders. You watch bigger volume coming in, I also watch the bigger volume coming in. Right? Then what differentiates yourself from a professional trader? Right? So when everyone have access to the same sort of information, now everyone will be able to see this information, right? So what happened here is that sometime back, price took a support over here, and sometime back price exactly took a little bit higher. It took a support again. Price is taking support, and price is taking support again, and price took a support again, and again we are very close to that support point. So many people think like, oh my God, this is my buying opportunity zone, because price is touching this zone multiple times. So probably this could be support. Is this a logical way to arrive to such kind of conclusion? I'm just asking this question to you people. Is this a logical way to come to arrive to a conclusion? Is this a way to trade? Is this a way to trade? Or probably will think like, oh my God, my risk is very less, right? Now, the moment people figure it out, my risk is going to be very less because my stop loss is somewhere below this zone. Many people will come to such kind of conclusion. That is where the problem comes. When many people thinks the same thing, that okay, market is trading at the support, and probably many more and more people think about this, the more and more people are going to take a trade over here, and more and more people are going to keep a stop loss in this zone, right? It is that is what it's going to happen most of the cases, and most of the people are going to keep a stop zone over here, right? So ideally what happens is that many traders piles on whenever the market comes to this level. Probably around, probably I'll say like the level is somewhere around 10,000, 10,120, and anywhere between 10,000, 10,050 or so, or there's those past swing highs, past swing lows, right? So these are the swing lows. These are the major swing low which happened on Gujarat election, and this is again one another major swing low which happened. All these are major swing low points. When market is coming to such a visual reference level, right? So we often tend to have our thoughts like, okay, this risk is very less because many times price bounce back. When many times price is bouncing back, it is making the levels even weaker and weaker again, and more people are willing to keep their stop loss below this zone. So some people will think like, okay, 10,000 could be a better support zone because it's a psychological support, and many people will try to buy at the support zone also. They want the support to be tested 10,000 exactly, and then it will bounce back. Does it ever happen? Right? So price comes. You would have seen that many times. Price goes to the 10,000 level, and then it exactly reverses back. Right? So 10,000 levels, and then it exactly reverses back. But in reality, does it happen that way? No, it doesn't happen that way. Probably whenever you're seeing that 10,000 comes back and again falling back, probably 2 or 3 days it goes down again, it goes back, and it tests it out, right? So most likely weaker hand players think like that. They'll think like the round numbers. They come and buy exactly at the round numbers figures, and most likely there are many people that they'll think like 9,000 is going to be the support, 10,000 is going to be the support, 10,500. All these are round numbers, right? So those are the round number places where most of the traders initiate their trades. Somehow they'll arrive to the conclusion. Somehow they look into their Bollinger Band, or they will look into their stochastics, or they will look into their RSI, and they will try to do what they want to do based upon what they visually look into it, right? And yes, that's how it is, and it's a very classical problem. What a trader has to do is that rather than thinking that this is my exact resistance, price has to definitely, it comes and respects the resistance, and then it should fall down, right? So that is what most of the traders have, that mindset. That mindset has to go away. Exactness kills the traders. Exactness kills the traders. I'll say, probably I'll reiterate again. Exactness kills the traders, right? So especially the short-term traders and intraday traders, it kills the traders. One better thing to do is you as a trader has to stay away from the exactness, trying to play, thinking that this is my resistance, that is my support. That kind of assumptions has to go away when you want to evolve as a professional trader. The more we are going to think very exactness, the more you want to try to be very perfect in these markets, more the market punishes such kind of traders, especially when people think like, I'm gonna market gonna come and touch my resistance, I'm gonna place my stop loss very close to that, or very 2 points high, 3 points high, those kinds of things. Very often the stop loss will be get hunted again and again and again. I'm not saying that stop loss should not be kept, but it should not be kept probably the way we are thinking about the resistance and support, that has to be go away. Some people will think like previous week high is my resistance, previous low is my resistance, 2-day low will be my resistance, 2-day high will be my resistance, right? This is a very classical problem here. Many people, most of the people place their stops at day high or day low, either knowingly or unknowingly, right? Or day low. Or this is mostly a classical intraday players problem. They generally tend to problems, right? So it is not, they're not the only one doing the thing. Probably most of the intraday players does the same thing again and again. That is where most of the players stops getting hunted, right? So by knowingly or unknowingly, somehow they try to figure it out. They usually play the stops mostly at previous day high or previous day low, or some people even does this 2-day high, 2-day low, 2-day high, 2-day low, 2-day low. This is mostly the positional trader does that. Positional player does that most of the cases, right? And even some people will look for some even more higher confirmation. They'll go for 3-day high, 3-day low, 3-day low. So one of the things has to go away from the trader mindset is that placing the stop loss at day high, day low has to be go out, because Every trader does that. Every trader who is either a beginner trader or 1 or 2 year, 3 year, 4 year experience in this markets, they does the same thing again and again in this markets, and that is where most of the time their stop loss is getting hunted repeatedly. So probably you would have thought like someone hit my stop loss, hit my stop loss. Who is that? Who is that? Algo? Is it an algo? Is it an algo, or is it an operator, right? Operator, or is it some smart money? Some smart money who knows where I'm keeping my stop loss, or is it my broker? Is it my broker? Is it my broker? This is a question which will be prevailing in most of the traders' mindset, right? So nobody is interested in where you're keeping your stop loss, right? So nobody is interested in neither the algo is interested, neither the operators are interested, neither the institutions, uh, smart money or institution are interested in someone's stop loss. But they are interested, either it could be an algo or in smart money or institutions, they are interested in where most of the people are keeping the stop loss, right? So the smart money is interested in knowing where most of the people keep their stop loss, keep their stops. So where people keep their stops mostly at the previous day high, previous day low, or previous week high, previous week high, or previous week low, today high, today low. So this is a very common thing people does it. Or they will be having some concepts like pivots, pivot points. People used to play around some pivot points, swing high, swing low. Some most of the swing high, swing low, swing high, swing lows. So these are the places generally people try to attempt to take an stop loss over there. Probably maybe I can take an example from today's Nifty future example. Take this. This is today's Nifty future charts. So Nifty on the, let's say I'll take a 5-minute charts. Nifty is not breaking the previous day low. So the previous day low was somewhere over here. Right, so you can see this is previous day's low, right? So to be very precise, this is previous day low. You can see when it is breaking, it breaks with an it breaks with an probably it would have been breaking with a heavy volume. It breaks with a heavy volume. Whenever you see that whenever a previous day low is broken, right? So probably maybe I'll pull out volume over here. Volume, where it is. Yeah, here it is. It's volume at price. It's supposed to be volume. So whenever it is taking down, you can see similarly that whenever it's taking down, it's coming with a significant volume over there. It's coming with a significant volume over there. It's not very big, but then it's considerably higher for that day. You know why it's happening? Any idea why it is happening? Why the volume is quite relatively high? This particular candle, when it is breaking the when it is breaking the previous day's low, previous day's low, your volume is quite impulsive, and it makes a significant swing low. Again, there is again an impulsive volume coming in. Why it is happening? So it is happening for a variety of reasons. One of the reasons it is happening here is that most of the people take a stop loss at the day's low. Probably they would have been taking the stop loss at day low. Probably if you're looking into the Bank Nifty chart, similar thing was happened yesterday. Today it broken yesterday's low as well as previous day low as well. At the close, you can see the volume is getting triggered because the volume was relatively high. It broke on the 2-day low today. If you're looking into the charts, it broke on 2-day low. So of course, this is the 2-day low. Last 2 days low, it has been broken out. Yesterday's low also got broken out around here, and this is 2-day low. Both the day lows got triggered. Whenever it triggers with an huge volume, especially when the market is emotional, market is making a major swing high, swing low, right? Those are the places. It generates huge volume because more and more people keep their stop loss level. So one of the thing has to go from the mindset is that you should not exactly, probably something else. I don't know where to place the stop loss, but you know better about your trading studies, right? So I'm not here to say. What I'm trying to say is that most of the, you're not the only one who is placing the stop loss at previous swing high, swing lows, or previous day high, day low. Probably somewhere else. It should be kept somewhere else, right? So when you're going to place your stop loss at where most of the people does, and most of the people, again, they used to place at the psychological reference. Like let's say current longs, most of the longs would have been they have a they have a fair idea of where to keep the stop loss. They generally took 10,000, especially the beginner traders, are probably 1 or 2 years experienced traders. They figured out 10,000 never hit in the last 6 months. Probably I'll take 10,000 as my stop loss. If it goes, it goes. Right? When most of the people thinks like 10,000 is a stop loss, or 10,050 is a stop loss, 10,075 is a stop loss, market often opens with a big gap down below that reference, taking everyone underwater. Right? So when our trading in such zones are kind of risky, it is also highly rewarding as well, right? Yes, price stopped most of the time. Probably we can anticipate, right? So we can anticipate, okay, it says it already stopped 5 times, 6 times, but probably I can take one more chance, right? Because my risk is only 100 points. Maybe the reward could be some 300, 400 points. I'm willing to take that risk. When you think that risk is going to be very less in the market, that is the moment where most everyone thinks in our same line. Probably one of the question you have to ask is how different are you? How different are you from the crowd? Are you from the crowd? So in order to answer this question, so we need to understand what is the crowd? What is the crowd doing? What is the crowd doing? At least, right? So that you know that at least you're different from the crowd. Right? So what is the crowd doing? What is the crowd does most of the times? What is the crowd doing most of the times? So it is not always not a good practice to trade against the crowd, right? So crowd is sometimes intelligent, sometimes dumb. So the key thing is knowing when the crowd is doing dumb things, so that you can trade against them, and knowing when to trade along with them, right? So first, probably we have to think about in these terms. Yes, we have tools, mathematical tools, RSI, EMA, MACD, stochastics. A lot of variety of tools are there, and even there are a lot of custom indicators, complex mathematical formulas. Everything is there, but ideally, it narrows down. Probably somewhere you're going to figure it out how to you're going to looking into some patterns. You're going to test visually, or you're going to back test statistically. But the key thing remains the same thing. What is the crowd doing? How different are you from the crowd? Probably that is what keeps you in the long term. That is what keeps you in the play, for long term. Right? Why I'm saying this? Because 99% of the traders lose money over a period of probably I can say like 5 to 6 years. Means every 4 or 5 years market and old trader goes out, new trader comes in, right? It keeps on happening repeatedly. So if you want to survive in this game, maybe you may be using RSI, EMA, MACD, but you need to think about in those terms. How different are you going to keep the stop loss at the where most of the crowd is going to keep the stop loss? Then you're no different from the crowd at all, right? So because the crowd does the same thing and you're also doing the same thing, no matter what, how intelligent your trading studies are, right? How complex your indicators are. The moment you're going to keep your stop loss there, or the moment you start thinking that my support is going to be exactly going to touch and then I'm going to take a trade and then markets are not going to fall down exactly, that kind of exactness kills the traders, right? Especially the short-term money. Maybe it might work for investors, right? So, but even if the investors 1 or 2 times they're going to fail, they're going to take a very little hit. Whereas and it's not going to take an impact on them, because most of the cases they are not going to have an M2M. You do a one wrong thing over here, you are definitely going to incur drawdowns, or you're going to incur M2M the day, M2M losses, right? So once you lost it, it's lost. Again, you have to recover back. The same case is not for the traders. So the same case is not for the investors. So you have to think from the trader's perspective, not from the investor's perspective. And many people have this opinions problem, right? So they somehow they learn the basics of trading, right? And then they want more confirmations. So they get into reading a book about technical indicators, or they go and look into YouTube videos to check how I can fine tune my trading strategies. And they will be looking into Fox News. They'll be mostly looking into some news channels to confirm the expert's opinion, right? So generally they want to confirm with their expert opinions, especially if you are watching the TV channels, hearing a lot of analyst opinions, right? Every analyst have their own opinion, right? They could be bullish or bearish, and it is not a good way to trade with them, or trade with their view, or trade against their view, because every opinion, every analyst, every trader has their own opinion. But the problem is that their thinking will be in a different time frame. Probably an analyst A, probably he will be saying from the investment perspective. Probably an analyst A will be saying from an investment perspective. Or probably the analyst B, he might be bullish in a long term. He might be in a bullish period. He might be a bull, and he might be thinking from an investment perspective, right? Whereas the analyst B, he might be thinking from an intraday perspective, and he might be saying that the market is going to fall. So everyone has their own different analysis in the markets. Everyone have a different opinion about the markets. That's how market exists, right? So if everyone is going to have the same opinion, that everyone is going to, let's say everyone is going to be in a bull side, then who will be coming and trading on the other side? So that's how markets are. Every trader, if you go and check with every trader's opinion, probably half will be on the buying side, half will be thinking on the sell side. But what matters is that everyone will be having a different time frame of holding. Someone want to trade for 2-3 minutes, and some people want to hold it for 1 or 2 hours, and some people want to hold it for 1 or 2 days. Some people will be thinking from the how long to hold this, for a month or 2 months or 3 months. Some people will be think about years, right? Some people, so if I want to buy this stock, how many years can I keep it this for? 3 years or 5 years? So time frame differs. When the time frame differs, your opinion differs, your risk differs, everything differs, right? So one of the things has to go away is double confirming your opinion with other traders. Probably both will be right, but when it comes to execution, both will go wrong. That kind of things are possible, especially when you are trying to confirm with other traders. So you learn something in the markets, you know something about markets, you learn technical analysis studies, but then again somewhere we need to tell something like, yeah, I'm doing something right. So we will try to double confirm with analyst opinions or experts opinion. We get into social media, and then we'll try to find who is the best trader over there. We'll ask, hey, how do you feel the market is going to, are you thinking this market will go down or are going to go up, right? So when the analysts also say that the market is going to go up, and you're also having a tendency that this market has to go up, you feel it's an emotional factor. Like, it's an emotional factor that you want some sort of a double confirmation before initiating a trade, so that ideally what you want is that what you want to hear, nothing much. So somehow you try to figure out that based upon your technical analysis studies, you figure it out whether to take a trade or not to take a trade, and then now we want opinions, right? So that is where we go to technical analysis people. We listen to TV channels, and then we'll talk to our informed trend, who is a better expert trader. We go through the forums, and then we'll check whether what the other people are thinking, what the experts are thinking, right? And then we look into the research reports, what Goldman Sachs is saying, what Morgan Stanley is saying, what is the Fitch rating, and all these things comes out, right? So And that is a problem with the opinions. The more you're going to double check or triple check with others, more noise you're going to create in your trading studies, right? And of course, that is not the only problem most of the traders faces. These days, social media bias is the biggest challenge. we read blogs, we get into Facebook groups, Twitter updates, and YouTube videos, right? So many places we'll be looking for confirmation. We'll be looking for what is the best strategy. Again, that is again a major question faced by most of the traders. So what most of the traders look into, they'll be searching throughout their career, throughout their trading career, they'll be asking the same question to again and again. You go to any traders conference, or you go to any kind of you go to any kind of meetups, traders meetups or forums, online forums. So what is the best intraday indicator, right? Intraday indicator. This again and again, people will not settle down on this indicator. People will not settle down on this question. The search has to stop somewhere, and then probably you have to self-master what you learned. So this question has to stop. This question has to stop because there is no best intraday indicator. Even the indicators are what? So indicators are what, right? So indicator, I would say that it's just plain mathematical formulas, right? So, and the mathematical formulas, I think mostly it doesn't have brain to predict the future. It doesn't have the brain to predict the future. I guess so. I believe so, right? So so you take any formulas. It could be Fibonacci, or it could be anything. It could be Ichimoku. On the underlying core, it is just a basic, simple mathematical formula, which will not tell you how the market will move next. Probably it is our assumption that we are thinking that, okay, this is my support, because visually we are seeing those indicators, and then we are coming to an assumption that this mathematical formulas have some sort of prediction power, right? So, but ideally, the realistic scenario is that it's just a very simple, plain mathematical equations, nothing more than that. It takes the input of price and then it throws something out, right? In forms of oscillators, in forms of bands like Bollinger Bands, or in form of averages, right? But ideally, we are the one who will be looking for where there is a crossover. Most of the people trade crossover, right? It's crossover, EMA crossover, or Bollinger Band crossover, and we are the only people who think like the crossovers are bullish, because we've seen in the past that crossover worked. But then the problem with the crossovers are there that when the market conditions change, the crossover behavior will be different. Crossover behavior will be different. Means the crossover scenarios are your technical indicators. It could be any technical indicators, or it could be crossover, or it could be anything. Maybe in generic term, I'll say indicators behavior change. When market condition changes, your indicator behavior changes drastically. And probably in a trending market, it might work well, whereas in a range-bound markets, it will not work well. Whereas some certain indicators like stochastics, it works really good in a mean reversion mode, whereas when the markets are getting into trend-following mode, it fails to capture most of the biggest trends. Probably it will be able to good in catching the bottoms in some of the cases, but most of the cases, it fails to hold for a bigger trends. And so that's again a classical problem with the stochastics. I would like to show that, right? So again, you can see that it can think like it had captured the bottom really good, and probably I can able to make some decent money there. Most of the people does this visual confirmation, like, oh my god, I made this money over here. And probably you think about this bottom as well. It is quite extreme bottom, and then it also given, these are most of the analysis has been carried forward by most of the traders, right? So probably here also this is making money, and you think about this scenario, probably it is making, you would have made money over here as well. So everywhere it is keep on making money. And then you try to come up with an such kind of visual assumption, and you took a trade at the fourth scenario, let's say somewhere here, or somewhere you took a trade somewhere over here, and you feel that it's different. It's not a bottom at all, but this time the market has changed its equation. This time you can see market is behaving something different. It's not like before. That is the problem with the most of the indicator. It's not the problem with the indicator itself, that it's a problem with our thinking, right? When the market condition changes, your indicator behavior changes. It could be something different, right? Because ideally what it is reflecting is, it's just nothing but a derivative of price. What the price is trying to do, the indicator reflects that, because that is part of the equation, right? And what you can do with this indicator is that instead of trying to predict what the market is going to do, so what we can do with the indicator, So what we can do with these indicators is that we can write rules instead. We can write rules. Something like, if this happens, buy, or if this scenario happens, sell. You can write rules. You can derive strategies. You can derive trading strategies. When to buy, when to sell, how much to bet. All these things you can derive with these indicators, and you can use these indicators to control risk, right? Control risk rather than predicting the markets. Right? So the moment you start thinking about predicting the markets using these indicators, ideally you have to keep in your mindset that these are not astrological tools, they're not crystal balls, right? So they're just mere technical analysis indicators which has been invented back in 1940, or even quite in the 18th century or in the 19th century. It's a very, very, very old classical technical studies. People are back in then using the graphing tools. And now we have modern technical analysis trading softwares, right? So for automated computation. The problem is that everyone has access to these kind of basic elements, right? So everyone, you learn stochastic, you learn RSI. There are thousands of traders, 10,000s of traders who are coming as a beginner. They also learn these kind of stuff. And probably most of the people are getting access to free tools like TradingView. At least these tools are quite not popular. It's tough to procure during the phase of 2005, 6, 7, 8. But now, because of the technological advancement, many traders get hang to that, and especially every trader who are starting with, they will be starting with either with RSI or stochastics or EMA, and then we got hang on. What we learned the very first time, we got hooked onto it, and then we'll be thinking how to refine it again and again. That is again. So that is another question which comes arise. I know that indicator provides whipsaws. Indicators often whipsaws, right? Often whipsaws. Especially morning, I was looking into one of the indicator. It's a very classical indicator. This is something like this. Many traders use 200-day moving average, right? So I was just watching this 200-day moving average in Bank Nifty 5-minute charts. On a lower time frame, it is continuously. You can see how many times it is whipsawing. Probably 200 moving average. Many traders use it. So far, initially they get used to it on a daily charts. Later on, they want to try the same thing on a Harley. They want to try it on lower time frames as well. Sometimes they'll see like it's very fascinating. It touched and then it crossed and then it gave me 100 points, 200 points. But there are certain scenarios it keeps on creating a mess again and again. It keeps on creating a mess, right? So then people will think about, okay, how I can reduce this noise? Can I combine something else, right? So that is where the problem arises. The moment people think about how to reduce the noise, we don't know how to reduce the noise. Probably we will say like, okay, let me add two more EMA crossover, or somewhere I'll add a ATR to it, or I'll add CCI to it so that I can reduce the noise, right? So again, they'll be mostly doing that brute force testing. They'll be doing some testing with probably I can combine with Ichimoku. Let's see how it works. So it's mostly and brute force thing is happening most of the time to avoid noises rather than trying to understand that it is the nature of the markets. It is the nature of the markets to create whipsaws, right? It is the nature of the markets to create an whipsaw. An indicator a mere mathematical formula with a simple mathematical equations, you cannot avoid whipsaws. Probably the only thing you can do is you can learn to, you should learn to accept that whipsaws are possible, and then probably you can think about it in a better terms rather than trying to avoid whipsaws. We'll be trying to eliminate. When the moment you started trying to eliminate whipsaws, more and more noise is going to get generated rather than you're going to remove the noise, right? And so probably it's easy to argue, right? It's easy to argue that I can combine with Supertrend, or I can combine with the Bollinger Band. I can avoid the noise easily. It's easier to set, but when it comes to the live markets, when we see the reality is very, very far from our assumptions, our thinking process. So first we need to understand what is reality. What is reality? How far are we from thinking about the reality, right? So again, the classical thing is that many people, many traders, probably 1 or 2 years old traders, they learned that something is called Ichimoku, right? So we have an Ichimoku charts over here. Yeah, Ichimoku charts over here. They find it quite fascinating because it gives a nice, smooth, clean return. So if I bought over here, I can sell it over here. If I can sell over here, I can bought over here. I can make some easy money. It's like probably I'm getting some small whipsaws here. That's okay. And probably some more whipsaws over here. That is okay. And I'm again making money. Some whipsaws. I'm making bigger money here. And whipsaws. That is what it kills you, the trader, and it kills the. So these are the phases, right? These are the phases. Let's say you are doing it on a hourly time frame or some other higher time frame. The continuous whipsaws over here, it makes you to get out of the game at some point of time, because probably the trader would have been taken a high leverage, and in kind of such a high leverage environment, you can see such kind of whipsaws comes very frequently. Probably you're seeing about only this making money process. Probably what we are not including into it is that this whipsaws we tend to ignore. Probably the whipsaws which are coming over here, we tend to ignore. This will give you 5 continuous losses, 6 continuous losses in a row, or 7 continuous losses in a row. Probably whatever you made over here, all these things will be eaten up by this whipsaws. All these things will be eaten up by this whipsaws, continuous whipsaws. All these whipsaws would have been eaten up, right? So on the hindsight, looking visually, indicators looks good. Maybe you can say like, oh my god, I can try out with maybe 30 minutes is noisy. Maybe I can try out with Harley. Again, the problem is that the same problem we are going to face with the same set of problem. Again and again, we are going to see the whipsaws over here. That is again whipsaws over here, a lot of whipsaws over here, and whipsaws over here. Again, so okay, I'm getting whipsaws. So how I can mitigate it? And then people goes for, okay, let me check with Bollinger Bands. Okay, let me say I'm gonna put some Bollinger Band. I'm gonna avoid some noise. Let's say how it works, right? So we get into that again. We get into that brute force mode, and then the problem. But then the problem remains the same. How much ever you're gonna do, how much ever you're gonna back check. You want to find that holy grail where that mathematical equations are matching. You're looking for the Goldilocks conditions. Like you are mostly we are looking for, we as a trader want Goldilocks condition, right? So where everything is perfect. That's what most of our trader searches for. We know we are good at something, but then we don't want to do it. But because we want to fine tune it even much better, we want to fine tune it better. Probably you are good at investing. You're good at investing, and then you want to pursue trading. You want to pursue trading because you are good at investing. You don't want to do that, but still you want to make how to make some decent returns in the markets, but you don't want to do that. Probably you want to pursue trading, and you want to generate faster returns because you are good at investing. You know that, and you think that you can apply the same principles into trading, and you can generate even more faster returns. And because the same rules, you think like it will be applicable in trading as well. But that is totally wrong. as I said, the trading is a different game, ball game than investing. Your time frame differs. When your time frame differs, your thinking has to differ a lot, right? And probably, maybe you may be good at, maybe you might be good at positional trading, and then you want to pursue intraday trading because you think like the same thing, same rules I can apply for intraday, and I don't need, at least in gap positional trading, there's a gap up, gap down risk. So I can do intraday, I can do the same mathematical formulas, and I can make money easily, right? I can do intraday trading, right? Again, the same game goes on and on, because you want to eliminate some risk, and instead of that, you know good at something, you're good at positional trading. Because of that, you want to eliminate gap up and gap down, so that you want to pursue intraday trading. That is really a bad idea, right? That is one of the really bad idea to do that. So it's always good to know what you're good at. Are you good at investing? You do only investing. Are you good at doing positional trading? You do only positional trading. Are you good at intraday trading? You do only intraday trading. Or if you think that I can manage, I know how to manage intraday or positional trading. I guess it doesn't comes with an attending a webinar or a seminar. It comes with an self-experiment. It comes with an self-experiment. It comes with an thought process, how to control risk, how to mitigate risk. And then it comes with screen time. It comes with screen time, right? So probably if you're a 1 or 2 years old trader, probably you never experienced that bear market at all, right? And then I said it's experience, and then it requires a lot of screen time. It requires a lot of screen time. Probably you never experienced to a tightly compressed markets. Probably you never experienced that highly volatile markets. Probably you never experienced a big gap ups, big gap downs markets, right? So it, of course, it takes time to get yourself better and better, right? And then it's going to take a time. Time is what most of the people, they are not willing to commit. Most of the traders, they will be looking for an easier solution. Most of the traders, probably I would say that I would have met 75% of the traders. 75% of the traders mostly looks for a easier solution. A solution. What is the solution they're mostly looking for? Again and again, we narrow down to the a solution which gives an exact entry, perfect entry signals, perfect exit signals, perfect stop loss, perfect support, perfect resistance. That perfection has to go away. So easier solution, I would say, like easier solution is nothing but in their terminology, it is a perfect stop loss, a perfect entry, perfect predictions. Maybe you can say the perfect predictions, or perfect resistance or support, right? Resistance or support. Maybe if you want to play the game better, right? First accept the reality. Accept the reality of your indicator, or probably your trading strategies. What are the pros and cons in it? You try to understand, analyze better, right? What kind of returns I can get if I want to trade this? What kind of risk it persists, right? When I'm trading such kind of strategies, what risk it persists? Rather than double confirming with my friend, how I can make myself better as a trader. And there is again a lot of classical problem faced by a trader. Again, they'll think like, I'm gonna add more indicators, and I'm gonna find the signal out of the noise. I'm gonna eliminate noise by adding more and more indicators. I've seen most of the basic, 1 or 2, 3 years experience indicators, 1 or 3 years experience traders. Every trader, they have such kind of studies in their screen. Probably they want RSI to be perfect, stochastics to be perfect. So like something like this: RSI to be perfect, stochastic to be perfect, and then some MACD to be perfect. Then only they'll be looking for a trade, right? So it's called indicator piling. Probably if you're and then there are more other parameters also to check whether it's a support or resistance, R1, R2, Camarilla pivots, and then they'll be using Bollinger Band on top of it. The charts will be looking very clumsy, and rather than removing the noise, it's going to generate noise. I'll tell you why. Because the win rate if you, no matter what, how much ever the conditions you want to make, right? Any classical technical analysis indicators on a lower time frame or on a higher time frame, your win rate will be anywhere between 24 to 36%. Any classical indicator, you put any rule. So now you're going to make a combination of rule. I'm going to see this information. 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 If this information is this value, if this information is above 36, if that MACD is greater than 0, then I'm going to take my buy decision. So when you're trying to arrive to that kind of conditions, again, your probability of winning, it revolves around anywhere between 24 to 36. That is a maximum probability you're going to get. Maximum probability is nothing but whichever the indicator is going to have the maximum probability, you're going to get the same winning probability over there. So first try to understand what is the winning probability. Winning probability is not an issue at all for a trader to survive or to make money in this market. But winning ratio is one emotional factor, right? So even you can make money with 20% win rate also, 30% win rate also, 40% win rate also. It doesn't matter because winning rate is just an emotional factor. But reality, try to understand the reality. What is your winning rate rather than trying to check visually for 1 or 2 places or 3 or 4 scripts. Try to check as much as possible. Maybe an 100 observation, it's also not enough. I would say that you go for an 500 observations, 1,000 observations, and then you check, validate yourself that whatever you're doing is statistically proven, right? Unless it is not statistically proven, or you learn how to do such kind of statistical analysis rather than looking for a visual confirmation. Visual confirmation kills the trader. Visual confirmation, exactness. This is what most of the traders does that because it's easy to do. It's easy to do. It takes a less amount of time. Probably you don't want to do an homework at all, right? At least to do an engineering, to do a doctorate, you cannot just like that by attending a seminar or webinar. You cannot just like that. You cannot do it. It takes time. Obviously, you have to understand that it takes time. So if you're going to put effort, put your real effort over there rather than putting in half-baked effort. Just looking into the charts 1 or 2 times and seeing that, oh my God, this indicator had predicted something and they've given me drastic 300-point results in Nifty in one trade alone. Right? Don't try to get into that kind of hang up. Try to understand how many whipsaws it is giving, how many consecutive losses it is giving. Can I withstand those consecutive losses? Again, consecutive losses is a problem what most of the people don't want to take it up in their trading career because they never thought about it. Maybe I'll put a question in this a different way. How many consecutive losses? How many consecutive losses you are willing to handle? You are willing to handle, or how many? Or think about this stuff. How many consecutive losses you can withstand with your trading style? How many consecutive losses you can withstand without going bankrupt? Right? So probably these are the questions you have to ask before trying with any kind of trading strategies. Right? Are you able to, or I can say, I'll put a question like this. Are you able to withstand if 5 to 7 consecutive losses losses is going to happen? How much you will be down? How much you will be down? How much you are going to lose? Probably 20 to 30% of the capital, or probably even more. If it is even more, let's say you're saying that maybe I will be down if I'm going to face 5 to 7 consecutive losses in my trading style, I might be losing anywhere between 50 to 70%. Probably something is still wrong with your methodology. You have to change your methodology. You have to change your thinking about your indicators, your process, right? Something. So maybe you might be betting more. You might be betting more if you're going to lose. In a 5 to 7 consecutive losses, you're going to down by 50 to 70% of the time. If you're going to lose, then probably you're betting aggressively in this market, and probably you are you're over aggressive trader, or probably you're over trading. And never think that my trading strategy will never give 5 to 7 consecutive losses. Every trader in this planet, it doesn't matter. Not only the traders. Investors, traders, hedge funds, institutions, mutual fund, Warren Buffett, George Soros, everyone have their best scenarios as well. Everyone will go through a rough phase as well. Everyone in this planet, no matter how intelligent you are, everyone goes through a good growth phase as well, a booming phase as well. But the question here is how much you're gonna make when you're in a booming phase, and how much you're gonna willing to lose when you're going through that bad phase, right? So it's again a question about risk. Only you have to talk to yourself, and then you have to come to such kind of conclusions, right? And the better thing is that try to avoid using too much of indicators. Too much of indicators, you're going to end up with more and more noise rather than you're going to trying to figure out what is the signal from the noise, right? And if you're thinking that your chart is looking messy, probably you have to think about using lesser indicators, or better thinking about markets. And what else? We talked about whipsaw problem and averaging loss problem. This is a common problem which is there with most of the traders and also with the investors, right? So you think about the investors who averaged Kingfisher Airline shares, think about the investors who average shares like JP Associates, Suzlon, or the shares like because they find that it's fundamentally sound. And the same thing, it's there with every time you incur a loss, you want to get out of it quick, so you average down at every downside. The problem comes when you don't know the market conditions and the market keeps on going against you. The averaging loss becomes an exponential losses, right? That is where again a key thing. Probably from an investing perspective, it doesn't matter for them, because again I said there is no MTM over there. Whereas when it comes to traders, your MTM is going to get exponentially increasing. Probably one-time averaging. If you think like one time I'm going to do only one-time average, it's fine for me. You have a process to it. You do it. That is no problem with that. But you're getting more and more emotional. You want to get out of the losing situation. So you keep on averaging down so that you bring down your cost price down. That's not going to help you out. Probably it will help you 20% of the time. 80% of the time, it's going to be very devastating to your way of style of trading. Probably one or two times you may get saved by averaging your trades, but one time you're going to get into such kind of situation, and this kind of situation happens 80% of the time. Probably you'll be saved only 20% of the time. Averaging losses, it's not going to help you 80% of the time, right? Put that in your mindset as well. It's gonna probably something else. Probably if you're okay to get out of the profit, it's okay to take a loss. That kind of mindset has to come up, right? So loss is always part of the game, and taking all losses, it's okay. It's okay to miss a game. It's okay even to miss a bigger profit also. What is not okay is, it's not okay to keep on losing the game and keep on holding to the game for a very long time. So that is where the time-based stop comes. It's always, rather than placing a price-based stop loss, it is also a good practice to keep time as a stop loss. If time is not in your favor, if certain things are not happening in your time frame, you're expecting the market to go up in 2 days, but it doesn't happen, it's not triggered your stop loss also. But something different is happening. When something different is happening, probably you have to think about, should I have to exit now, right? So somewhere the time as a factor has to be factored in your stop loss, not just a price-based stop loss, even a time frame stop loss. It helps you to mitigate your unwanted risk most of the time, right? Maybe I'll okay, let's talk about the other topics. And okay, again, this is again a classical problem. Probably most of the traders faces it. You have a lot of things on your trading terminal, and then you have a lot of stocks, and you'll be seeing the flickering screens throughout the day. Most of the people are staring at the screens, and then market is not doing something. They will be trying to figure out which stock is doing something better. Let's see which stock is up by 2%, 3%, or 4%. Then they'll try to analyze some stocks, and then somehow they'll try to find out some stocks out of it by watching the screens throughout the day. And then they'll do something which is not part of their plan at all. So they'll be doing something very emotionally, which is not part of their plan at all. Later they'll be thinking, why I had done this? It's not part of my plan. I don't have an intention to take a trade. But because of that, you started watching your screen throughout the day. You watching that red and green ticking up and down, up and down. It makes the traders emotional most of the time. The moment you start watching the price or price fluctuations, you're going to get more and more emotional. You know, when a trader takes an emotional decision, the market will be moving in a sideways mode for most of the time, right? So of course most of the traders will be watching from the outside. They want to take a trade because they'll be waiting for some sort of confirmation. When the confirmation comes, it comes with some sort of a downside, and then it will take the 2-day low or a daily low or a previous week low. It comes and takes with a spike, right? That is where most of the traders, they want to enter. That is where they want to enter, because they'll be watching the price all the day. The price is not doing something. Probably it is trading in a band of some 30 points. All in a sudden, it takes the day low or a previous day low with a spike. All of a sudden, the sudden movement is coming in because some emotional news-based reactions is got triggered, or we are seeing a big volume in the counter. It comes, and all of a sudden you want to take the trade because your indicators are turned negative, right? So that is where again a problem comes. Am I getting a better price to trade this kind of scenarios or not? Most of the emotional traders, they get into it. Somehow they will come to a conclusion that, okay, I have to come and get this. I got a breakout, and then now I want to trade, because they'll be waiting throughout the day for the range to break out. Now, probably market will be trading in a range, and then all of a sudden it breaks the range, right? And that is where most of the people's confirmation point are. Try to figure it out. Is this the right way to trade or not? Because many traders does the same thing again and again. When the markets are trading in a range, in most of the times intraday, they'll be waiting for some sort of breakouts, and they will have some levels. Then the level is breaking out. Is this a level what most of the traders also having the same level? Everyone watches the same level. When the breakout comes, is it an emotional? Am I emotionally taking a trading decision over here? Right? It's one of the questions you have to ask before you are going to initiate a trade. No matter what tools you are going to use, right? Or what you have to use it. Are you taking the trades emotionally? Because anyway, you can figure it out whether what to buy, what to sell, where to place a stop loss, where to place your resistance, what is the trailing stop loss. You can arrive within a fraction of seconds with an indicator. Mostly indicator itself now gives everything, right? So modern indicators gives most of the things, where to keep a stop loss, where to enter, where to exit. You just code it and then it gives you the trade. But still, you have to ask your question, are you emotionally taking this trade decision? If you're going to take an emotional trade decisions over there, or you're going to think impulsively, oh my God, this news is bad, my indicator is also turning negative, so it's a double confirmation to me. Anyways, analysts also, the TV analysts are also negative. Definitely this market has to fall down. If you have that kind of confirmation, or your expert friend told that market will definitely fall, if you're going to think about in those terms, then probably you're going to take more and more emotional decision. Whenever you're going to take a more emotional decision, you're going to bet more, and the chance of winning is just 20% over there, right? Especially whenever the emotional decisions are going to overrule you, you're going to lose the edge in the markets. So that has to go away. Somewhere you have to stop watching the screen throughout the day. Maybe it could be it could be randomly you're looking into it, but you're staring at the screen throughout the day, don't know what to do, or refreshing the intraday M2M to check whether it is positive, how long it is getting positive. That kind of behavior has to go away from the markets, right? From your trading process. So it's good to use less technical indicators, and then only you can figure out what suits for you. I cannot say, because everyone's risk nature differs. Probably I can afford for an 30-point stop loss. You can afford for a 50-point stop loss. Some other trader can afford for a 100-point stop loss. Based upon your risk nature, and you want to add more positions, I don't want to add more positions. You want to average at stop loss, some other people don't want to average it. Some people want to average on the profit side, whereas some people want to average their losses. They're okay with averaging at the losses also. So what is your trading nature? How risky you are, that is what you have to think about it. How risky you are when taking any trading decisions. Probably, even though the indicators are going to say something, ideally the humans are watching it. Indicators don't have emotions, whereas humans, they have emotions. Like human traders have emotions.
So they will be skipping some signals and they'll be taking some signals based upon their personal bias. That has to go away. And a lot of technical factors. Some people will be keep on changing the indicators. 3-4 continuous losses, the indicators is not going to work, so they move on to some other indicator. They try some other indicator, 4-5 continuous losses again, they keep on changing the indicator. An indicator runs well for 1 or 2 months, it will not make money for the 3rd month or the 4th month. They change the indicators. It's not giving enough profits, they change the indicators. And then they keep on changing the indicator. Because they'll be looking for a holy grail rather than adjusting to the market situations. They want an indicator which makes money in all kind of market situations, right? Yes, that is what everyone is here for. Everyone is here to trade for money, and we want consistent money. We want a consistent business from the markets, and then that is the challenge. That is where the challenge comes, right? And that is not so easy. You have to understand that it is not easy. The moment you think that making money is easy in these markets, that is where it's going to kill the trader. You think that making money is easy in the markets, right? The moment you think about it, the moment you're gonna think in that way, in that terms, you are doomed, right? So you're gonna get doomed because markets are extremely complex. You know why it is extremely complex? Markets are extremely complex. If it is easy to make money, right? If it is easy to make money, everyone will be making money. Everyone will be making money here. But and that is not happening. And that is not happening, right? So first try to embrace the complexity of the market. Then that is where you will be able to focus on the next level of trading. Probably you'll be able to focus on what others are not able to think, because many people think on the same terms again and again. The thinking process about the market has to change, because markets, it doesn't work on one single rule. Maybe it works, it needs different rules for different market conditions, right? So then how to explore? Probably you have to think in those terms. And then first thing is what not to do comes. That is what our topic for today is, what not to do. Well, once you understand what not to do, then you'll be able to it's easy to focus how to do things better, right? So how to first thing to do is what not to do. What not to do, it has to come up in your trading process. Once you know that what not to do, probably you are going to eliminate 60% of your trading problem. 60% of your trading problems get solved instantly. The moment you realize that what not to do, 60% of your trading problems get solved. And then if you know what not to do, then the question comes, then how to do things better. So that is the next level of questions you have to ask about it. Then how to do things better. If these certain things are not working, certain things, you know that whipsaws are there, then how can I deal with the whipsaws? Can I mitigate? Can I reduce my losses when the whipsaws are going to come? Right? That is the right way of dealing with the markets. You cannot reduce whipsaws, but can I reduce my risk when the whipsaws are going to come? How I can reduce my whipsaws? So that kind of thinking has to come in your so when you think about the markets in a better way, right? So the outcome will be even much better. And then, yes, as I said, time-based stop loss, it has to come as a part of the process, rather than using only a price-based stop loss alone. Price-based stop loss is good, but time-based stop loss will work even much better, especially when you are expecting in a 3 days Nifty has to go up some 200 points, and it is not going; it's doing something else. Probably you have to do your reanalysis again, and then that is where you think about objectively, right? That is where you learn to think about objectively. Otherwise, you will be in assumption that this indicator has to go up. This indicator says it's buy, so definitely market has to in a buy mode. So you'll be start waiting for your opportunity to come, and when the opportunity never comes, and then you'll get disappointed. By the time there'll be a serious losses as well at some point of time, right? So a time-based stop loss could eliminate. And it makes you to think in an objective manner, right? So rather than You being biased of the indicator, thinking that this has to work, this should predict perfectly. Using a time-based stop loss, probably you'll be able to avoid unwanted bias in your studies, unwanted bias thinking in your studies. Those kinds of things can go away. And don't be an impulsive trader. Like the demonetization happened, bear exit happened, market gap down. Oh my God, this is a market crash. Don't go and jump into those emotions, right? Tomorrow market opens gap down. Oh my God, the US market is down. Oh my God, the Chinese market is down. Oh my God, the Iraq war is there. Oh my God, there is a Korean nuclear attack. There is a possible nuclear attacks. Oh my God, the GST is not good for the economy. It is not many people are happy about the economy. Not many people are happy about the politics, right? Not many people are. So don't try to use that personal bias into your indicators. The moment you put all those bias onto the indicators, you will see only what you want to see, and that is where you'll miss the biggest opportunity. Right? The moment we started thinking such kind of in an impulsive way, the moment we are going to react in an impulsive way, and you're going to take an emotional decision rather than thought-driven, process-oriented decisions, right? So stop being impulsive and avoid rush at the open. Of course, every intraday trader, every positional trader, somehow they will figure it out. They want a very early entry because nobody want to wait in such kind of scenario. Somehow they'll figure it out what they want to trade, and they rush up just like madly. That is why you can see that the market opens, the volume will be significantly high every day. Most of the things, if you look at the volume charts, market open first 1 hour, most of the people pile up. Mostly the traders pile up when the market opens. They'll be waiting for the gate to open. They'll be waiting for the 9:15 bell to ring, and then rush up madly, right? So that kind of rushing should stop. So it should be something like this. At times, yes, you need to enter faster. At times, you have to learn to wait. How long to wait? That is where the art of the trading is, right? And most of the cases, your best trading opportunity is not at the open at all. Many people want to chase at the open, but if you look into the charts, statistically, your best trades will not come at the market open at all. Probably 20% of the time, maybe yes, but 80% of the time, it's not. So 80% of the time, you have to learn to wait to capture your best moments, best opportunities. And then it happens if you start waiting rather than being impulsive, rather than waiting for the gates to open, right? So that has to stop somewhere as a trader. If you want to evolve better, no matter what, whether your technical studies are saying something, it has to enter. Or if you want to follow rules, you have a very clear cut rules, you follow the rules, that is perfectly fine. But if you don't have any such rules, but still you want to think differently, then you have to learn what is the right time to enter, right? Most of 80% of the time, you're not going to get the best price at the open at all. Probably you're going to get at the middle of the day. That your entry point is not at the day's high or day low. Probably you're going to get at the middle of the day somewhere. So that has to stop. Again, we have a lot of wrong assumptions about high volumes, like the high volume which is happening. A positive candle, it's a positive candle, and then a high volume. Oh, big trader is there. Oh, small trader, the big traders are selling over here. Big traders are again buying over here. Big traders are selling over here. These kinds of assumptions has to go away by looking into the volumes. Volumes are nothing but a transaction between a buyer and seller, right? We don't know who is smart. We don't know how long they are going to willing to trade. We don't know. This trader is the trader who is coming with a big volume. Is it one trader or a piling of or a bunch of traders? 10 traders or 20 traders who are creating this volume? We don't know. We don't know that. We don't know where they're keeping the stop loss. We don't know that. We don't know how long they're going to hold. Are they intraday traders? Are they are investing for next 5 years, 10 years? We don't know that, right? So we are having a weird assumptions. We're thinking that every volume spikes are nothing but smart money is coming in piling up. We don't know whether they are entering or whether they are exiting their trades. So there are a lot of things surrounding the volume, which mostly people have a wrong assumptions about the volume. That has to go away, right? And yes, because there is for every buyer there is in every seller, right? So every equal amount of buyer, there is an equal amount of seller is there as well. So who is intelligent? We don't have any idea. Probably a seller might be a seller might be intelligent over there, whereas the buyer buyer have a different reason to buy. Probably he want to buy because he is already in a loss in his charts. So now he want to exit out of his buy. So he want to exit out of his charts. Probably the seller want to come and sell. He thinks like this is the one perfect place to sell this markets. He may be right. Probably the other guy might be exiting as losses, and other guy might be other guy might be a new entrant. He is newly coming into shorting. Probably the other guy who is already holding a short, he might be coming and exiting it. We don't know what is the reason behind the volume. Nobody knows, right? So to be honestly speaking, nobody knows what is the motive behind such kind of transaction. What is the motive behind such kind of high volumes? But often we have a thinking that if the volume is about 2 days average or 10 days average, 20 days average, we have such weird logical rules. A big volume spike, then our indicators also saying something, oh, that is my buy, right? That kind of weird logic has to go away. So those are the places, again, looking into the volume spikes, again, there are possibilities that you may end up in an emotional decision. So you have to ask that question again to you. Am I taking an emotional decision because of volume? Volume is a part of the thing which is inducing me to take an emotional decisions or not. Maybe you would have seen that 3 or 4 times. It gives a nice spike volume, and also price also moved up in tandem with the price. But most of the cases it is not. So probably your understanding about the volume is not better. I'm not here to discuss about what is the right way to trade about volumes. I'm here to talk about what not to do rather than talking about what to do in these markets, right? And again, the divergence is a very classical problem with most of the traders. Most of the traders who are 1 or 2, 3 years, 4 years, 5 years experience, they monitor divergence because it worked in the past. It worked in the past doesn't mean like it will work in the future also. There is no such guarantee, right? So, but then we hooked on into those patterns because it is discussed mostly in the textbooks. It is discussed in the YouTube channels. It is mostly an aftermarket study, I would say that. But live trading, it's going to be really difficult, especially when you're going to see a market something like this. Let's say there is a divergence which is happening over here. I guess this is a Nifty mid-cap charts. And then we are having a sort of a triple bottom over here. And then people will tend to take a trade over here. It naturally happens, right? So we will think like, oh my God, this is the right time to buy mid-cap because divergence is happening. But what happens is that at times the divergence will keep on happening, and then price keeps on falling very slowly, right? So the divergence happens because the momentum is very slow. The momentum is very slow. Probably the stock is falling very slowly, and you'll be keep on waiting. Even though previously you thought like the moment it breaks, well, you'll be thinking in this lines. The moment it breaks, I'm going to exit. That will be your initial thinking. But over a period of time, you'll see like it broken, but still your divergence is continuing. Then what to do next? Okay, let's see what happens. When the moment you started thinking about let's see what happens, that is where market shows its. So then what happens? The market will be showing a slow divergence because the momentum is pretty slow, and then the price also slowly falling down. You're not incurring bigger losses, but then your losses are getting increasingly higher and higher and higher. And then the moment you see that there is a sharp downside, and then the momentum declines, and then you see that, oh my God, there is no divergence now. Now you think about your exiting, you are too late to the exit, right? So probably you have a solid rules when to enter, when to exit. Don't change the equation. You have try to build a process around it. Try to build a trading process around it, and then you try to stick to the rules, right? It's okay to break a rule once in a 3 months or 6 months, right? That's what most of the best traders does. That most of the professional traders know when to trade their process, when to stay away from the process, but never try to change the equation every now and then. Just because of that you are in a loss, don't try to change the equation, right? So if you are initiating the trade and you are preparing for the trade, something different happens, and then you want to readjust, you want to hedge, that is a different ball game, right? And probably once you entered into the trade, don't try to change the equations. You initially thought that, but something different is happening. When something that happens more to the most of the traders, you try to enter into the trade, and then something different happens, right? And then no. You want to wait for some more time because some other indicators telling you buy. Probably now the divergence, now the price is falling down. Now you're seeing divergence in stochastics. Probably stochastics is at 20 now. because the price is at the oversold level. Now you want to wait for some more time because stochastics is now showing in a buy mode now. Probably you don't want to exit out of losses. Probably you think that probably there could be a mean reversion coming in because stochastics is now showing in an negative. That kind of things has to go away, because that is where monitoring the multiple indicator problem arises. One indicator shows buy, another indicator shows sell. So to your comfortness, because the indicators are falling, because one of the indicators is failing, you entered because of that, and now you are in a loss. Now you don't want to give up the loss, and you are seeing some other indicator to comfort your thought process. Like, so you're saying that okay, anyways it will bounce back because now stochastic is in buy mode, and then it goes down, and then you see some other indicator like CCA or MACD is turning positive now, but still you want to hold on to that. So that kind of things has to go away from it. So at times the divergence can keep on diverge, like an oversold indicator like an RSI, it can keep on remain oversold for a larger period of time, right? So this is an oversold indicator. As you can see, it's an RSI is basically a kind of a momentum indicator. It is also an oscillator as well. At times it can remain in an overbought and oversold period for a prolonged time, right? So if you're not understanding how long it can remain, and you're thinking about shorting this market, especially when the price is going up, or you want to getting long into this market every time you're seeing a hook reversal, you want to take a long. It may work in the past, but when in the future, it not necessarily it has to work, because your indicator phenomena changes in a different market condition. When the market dynamics changes, when you are in a low volatile period, when you are moving from low volatile period to high volatile period, when you are moving from a sideways market to a compressed markets, sideways market to an trendy markets, when we are moving from an gap up, gap down markets, highly erratic markets to an tightly compressed markets, the indicator also changes its phenomena, because that's how the indicators are. They're just mere mathematical formulas, right? So, and then this is again a classical game which mostly played by most of the traders. Again, all these things are taken by the TradingView community, and one of the trader thinks that this chart from CESE, he thinks that he's thinking that it is a support, right? So it is a support because it is nobody has a reason why it is a support, because of the lines are matching. It is a support, right? That's how the logical thinkings are so far from the beginner level, entry level traders. Not necessarily it has to be a support. Probably if you're thinking that it is my one place where I'm thinking that I can control my risk, I'm going to take my trade. If I'm going to lose, I'm okay to lose my trade. But when I'm going to lose, I'm going to lose only this amount of money. Some X amount of money I'm willing to lose. But it's okay. So that is my part of my process. Trendline trading is my part of my process. But when I'm trading this trend line, I'm okay. I'm not going to trust this, because if you're going to trust this, you will not keep a stop loss, right? So what I'm saying is that it's okay to trade a trend line, right? But think about what is the challenging thing involved in a trend line break. Most of the cases, how to draw a trend line, that is what most of the people think about it, right? So I'll say if I draw a trend line like this, if it's going to break, right, and it can again shoot up. Wow, how you are going to deal with this? Are you prepared mentally to deal with this kind of things? Right? Or you think about that there's a trend line over here and it breaks. How you're going to deal with it? If it's going to be a very big candle, how you're going to deal with this? Are you going to take entry over here? Is your entry point over here? Let's say I'm going to drawing a trend line or like something like this, and then I got a break with a big candle, the volume also big. How you're going to deal with this? How you're going to deal with the losses? How much losses you're going to willing to bet, especially when you're going to have this sort of thing. Are you going to looking for a retracement? You're going to look for a break. You're going to look for a break. The break come, and then you want some sort of some sort of confirmation with some sort of pullback, and you want to enter it short at that, so that you think that losses will be controlled over there. How to control the loss is what you have to think about more about, rather than thinking about profits, right? The profit thinking is good, but equally what is good is that thinking about the losses as well. And that has to evolve part of your process, trading process, right? And okay, so then comes the last thing. As I said, the breakouts. Breakouts are easy to trade. It's easy to visualize whenever the past swing has been taken out. You're not the only one who is doing that. Probably most of the trader does the same thing. Some people look for a 2-day breakout. Some people look for a monthly breakout. Some people look for a multi-year breakout. Some people look for a 52-week, past 52-week high-low breakout. And they do the same thing because it's easy to do. It's easy to do, and then most of the people does that. No harm in doing that. But the problem is that it's quite, trading the breakout is not always easy. So when it is not always easy, then what you have to do is that how to do it in a better way, right? So trading breakouts are mostly profitable, but I would say that the winning rate will be 40%. 40% of the time trading the breakout works, and 60% of the time it's not going to work. So when 60% of the time it's not going to work, especially most of the breakouts are mostly fake outs, in such kind of things, how you're going to deal with those losses, how you're going to control those losses. That's kind of thinking has to evolve if you want to get into the next level of trading, right? And I guess that's it. I'm just done with the session for the day. Maybe you can ask any questions over here. I'm happy to answer it. Or if the session, you can also mail me at rajendran@marketcalls.in. Okay, so there are a couple of suggestions from traders. So whatever the indicators you're going to use, maybe I'll put up. So some people are saying that you have to think from the context perspective. So you have to think from the context perspective. That's what a couple of traders, probably they are kind of an experienced traders, I guess. So they're saying that. So you should not think only from the indicator perspective. You have to think about from the context perspective as well. So context is what is going to tell you what to do, what is the right way of doing, when to do what. So that's what one of the trader Thakur is saying about it. And so some other traders are saying that zigzag retracements give good hints, right? So this is from Van Kumar. He's saying that he used zigzag retracement and it is giving him better results, right? So I also use a Fibonacci retracement along with it. It's working good for you. It's good, but what you have to do is, if you want to get better out of it, how I can control my risk when something is going wrong against me. Think about in those terminology as well. So rather than thinking about if I'm going to take this trade, how much I'm going to make money, instead of thinking from that terms, how much risk I'm willing to bet when I'm going to expect some X percentage of returns. All right. So we have to think about these terms as well, no matter what kind of indicators you are going to use. Right. So you know your indicators much better than me. Right. For somebody, right. So RSI is, what is that in RSI? It's a basic technical indicator. Chalo yaar. Right. But you know better about your indicator. So you need to do a groundwork. Should I have to really use this indicator? Or if I'm going to use this indicator, okay, this indicator is convincingly good, visually looking good. I statistically done some couple of tests, everything is convincing. So rather than going out and asking someone, other trader, like, hey, I'm using RSI, how you think about RSI? The other trader might say, nah, the RSI is a basic indicator, it might not work. Right? So everyone, as I said, every trader has their own opinion. Every different trader has their own. If you ask me, I will have a different opinion. Probably that's why I'm not putting any opinion about any indicators. Because every trader has their own opinion about markets. Because they think whatever we are doing it's good for us. Right? So rather than get out of those kind of thinking, rather than thinking that your indicator is always best, or you've seen some indicator which is always best, rather than thinking about it, go get into the groundwork and then do some real homework over there. Try to understand, probably write it down, try to have a good historical data and try to understand how it worked in the past, last 1 year, 2 years, or what are the real-time challenges you're going to face. Probably, so there are a couple of traders, right? So they will be good in analysis. And when comes to live markets, they face a lot of execution problems. Probably their analysis is going right, but somewhere they're still making losses. That is again the next level of challenge is what most of the traders has to go forward, has to solve it, right? They'll be really good in analysis, they'll be really good in predictions, but because of intraday whipsaws, they're not able to manage their trades. Every time the stop loss hits and then markets moves in their favor. Again, this is a classical problem faced by most of the traders, especially. So again, they will be think about, okay, if it is not, then how to put the filter. Again, the same loop continues again and again. Okay. What P. Thakur is saying that, yeah, again, the same thing. What is good for you, only you knows what is good for you. Right? It's recommending the same thing to your friend. Maybe it may not work for the others because they'll be having a different mindset. They'll be having a different risk equation. They'll be looking for probably you're looking for 1% returns from the market. Probably other guy will be looking always for 10% returns in a month. Right? So if rather than try to get the reality, what is really possible with the markets, what is not possible in this markets, and what is my time frame, what kind of strategy I have to adapt to mitigate the risk in my time frame so that I can improve my returns, right? So risk is the only thing what you can only thing you can control in these markets. Reward is what the market gives. If the market is itself not giving 100 points and you are expecting 100 points in the markets, then what is the point of doing it? The market is keep on moving in a sideways for 20 points for the next 3 hours and you are expecting 100 points. You got a buy signal, and because of you got a buy signal, market not necessarily has to go and meet your 100-point targets, right? So what if the market is going to do something what you haven't expected? How you're going to react? When you got an entry and your indicator is saying buy, you bought it, and then our assumption is that immediately it has to shoot up and then it has to hit your target, right? That is where with every trader's mentality. But what if the market is doing something different? And that is something different is what going to happen in real time most of the cases. How you're going to handle it? Are you have any scenarios in your mindset? How you're going to handle it? So are you going to add when things are going to go in your favor? Are you going to average down the losses? Are you going to have a trailing stop loss? Are you going to trail to the break even? Are you going to have a partial booking? What kind of process you have in your trading system? That has to evolve, right? And that is where you can keep your emotional status equation outside the trading floor, and you can do some real trading over here. Okay, so okay, there is. Someone is asking, webinar recording is available too. Yes, the session is getting recorded and it will be available in YouTube probably after, before the day ends, it will be available in YouTube. Yeah. So time-based stop loss means, okay, so let's say you're buying some call option or a put option. So time-based, someone is asking, what is a time-based stop loss, right? So time-based stop loss, it's like, you know your time frame. Like let's say I'm an intraday trader, I'm a positional trader. Let's say I'm a positional trader, and I will be mostly holding my position for not more than 2 or 3 days. 2 or 3 days, and I entered in let's say Reliance, or I'll say I got long. I got long in 10,200 CE. Right, so time is going to be an eroding factor over there. So rather than keeping a stop loss also along with that, you have to keep it's better to have a time-based stop loss also, because when you're going to buy futures and options as a time value rounds out quickly, especially if it's going to be an out of the money and you're nearing the expiry. So when such kind of scenario, let's say you are buying at, let's take an hypothetical example. Let's say you're buying this option at 40 rupees premium per lot, and you're expecting price to touch 10,300. Expectation is expectation means you want to achieve it quicker, right? So your indicator thrown a buy, but probably your indicator is supposed to be in a buy mode probably in another couple of hours or maximum 1 or 2 days. That market has to show 10,300. Probably your expectation is that you will be making at least some 60 to 80 rupees. You're going to make some profit out of your trade, But reality is that so price is not doing much. You are in a marginal profit. Price is hovering around. Price is hovering about 10,200 marginally, and then 2 to 3 days is over. 2 to 3 days we are in a sideways mode. So now what? You still want to wait? Time is running out. So most of your best opportunities, right? If it's going to take a more time, means you're losing your opportunity. You're losing your time. Probably there is most of the cases. I would say that 70% of the cases, if time is 70% of the cases, if time is not in your favor, it's good to take an exit. It's good to take an exit and get out of. Think about a better opportunity and think about other opportunity. Think about other opportunities. Right. So let's say I'm an intraday trader. My expectation is that my another half an hour or 1 or 2 hours it has to happen. If it's not happened, then do what? Should I have to carry forward? No, that is not the right way. Probably that may works again. 20% of the time it may work again. 80% of the time those kinds of things will not work. You think that you are in a loss, because in a loss you are in a loss, and then you want to carry forward your positions tomorrow, or because of that that should not be a gap down, but unfortunately gap down happens, and then you want to wait for 1 or 2 more days, right? So if time is not in your favor, it's always good to take an exit. When you're taking an exit, ensure that you're not taking an emotional decision. It's okay to take a loss. It is okay to take a loss, right? It's okay to take a loss rather than sitting on loss and waiting for recovery to happen. The moment you started thinking about, you started some sort of hope. It's called a hope recovery. You'll be praying to the God. You'll be looking into the stars, and you'll be looking into you'll be praying to the gods and saying that, oh God, please help me to some sort of recovery. Even though you know that everything is going wrong, your indicators are turning against you, but still you are hoping somewhere that you'll be looking into some other indicator. You're looking for indicators now to check which other indicators are in buy mode, right? So that is where that is where the objectivity get lost, and we'll be finally looking for what you want to look out for. Ideally, you don't want to get into losses, so you are hoping for the recovery to come in some form, in some other indicators. So you'll be keep on looking for an indicator. You'll be putting a Fibonacci retracement to check where the Fibonacci retracement is. Okay, it is 50%, so it means I can hold. It's a hope thing. You're hoping somewhere to recover, and you're ensuring those mathematical situations to come into your favor, rather than you have some process and that process is not working. Get out of that position, and then as I said, it's okay to take a loss rather than sitting onto a bad trades. And it is also okay to miss some good profits rather than getting stuck in a bad trade, right? Okay, fine then. So with this, I'm just closing the session. I think we had discussed enough about how not to trade. Probably it gives you some sort of a thinking process about what not to do, and then maybe you go back and rework things in a better way. And I guess it's a fairly decent knowledge sharing session, I guess. Right? And then thank you for your time as well. Yeah, thank you. And yes, as I discussed, it will be live in YouTube in another couple of hours. Yeah, thank you.